Welcome back to the Deep Dive, where we take stacks of complicated financial and economic sources and turn them into streamlined, essential knowledge.
You're here because you want to know not just what the rules are, but why they exist.
And, crucially, how to use them to your maximum advantage.
Exactly.
Our focus today is on building future wealth, specifically through one of the most powerful yet, I think, often misunderstood retirement vehicles in the U.S. tax code.
That would be the Roth IRA.
The Roth IRA.
It's an individual retirement account, or IRA, and its appeal is just. It's potent, you get tax-free growth, and, this is the key, tax-free distributions in retirement.
Provided you meet certain requirements, of course.
Of course. And we are going to dive deep into all those nuances. The whole account is fundamentally defined by one thing. Contributions are made after your income taxes have already been paid.
Okay, let's unpack that core difference right away, because it defines the entire strategy.
It does.
Most of the accounts you hear about, a traditional IRA, a standard 401k, they all operate on tax deferral.
Right. You put in pre-tax money.
You get a deduction on your taxes today, and you basically just postpone that tax bill until you retire.
The Roth, though, flips that entire script.
Completely. You pay the income tax now at whatever your current marginal rate is.
But then all that money grows, and critically, those qualified withdrawals you take out in retirement are entirely 100% tax-free.
It's a mechanism built on a calculated leap of faith, really, about your future tax exposure.
It is exactly that. It's a strategic bet against future tax hikes. And our mission in this deep dive is to unpack not just the basic mechanics, but the true political and economic origins of this account.
Which was named after Senator William Roth, right?
That's right, introduced in the Taxpayer Relief Act of 1997. We're going to help you analyze the source material to determine precisely when paying the tax man today leads to the maximum possible financial advantage for you, decades down the road.
Which means we have to look past the surface level.
Way past it. We need to understand the complex rules on contribution limits, conversions, and some of the really advanced withdrawal flexibility.
Before we really get into the tax mechanics, the stuff that makes a Roth so famous, we should probably establish what a Roth IRA actually is as an investment vehicle.
That's a great place to start.
I mean, it's not just a piggy bank, it's a holding container for wealth that has this special regulatory status. So what can investors actually put inside one of these accounts?
A Roth IRA functions very much like a standard brokerage account in terms of what it can hold. It's designed for flexibility.
So the basics, stocks, bonds.
At its core, yes, it holds investments in various securities. So common stocks, corporate bonds, exchange-traded funds, mutual funds, all the usual suspects.
Okay.
But the sources we looked at, they reveal the options are much, much broader than many people assume.
And what stands out there? What are some of the surprising assets you can hold?
Well, the flexibility extends to more sophisticated instruments. You're talking about certain derivatives, fixed income notes, certificates of deposit, so CDs.
CDs, okay.
And even certain types of real estate.
Real estate, that's one that always catches people by surprise.
It does. Because you just don't associate it with a typical 401k or, a retail IRA structure you'd open up online.
Right. And the fact that you can hold real estate in an IRA speaks to the investment latitude that the Internal Revenue Code gives these accounts.
It does, but, and this is a crucial caveat, the specific investment options you have available depend pretty significantly on the trustee.
The institution holding the account.
Exactly. The brokerage, the bank, the specialized custodian, wherever the plan is established. If you want to hold truly unconventional assets like a rental property or private equity, you probably need a specific type of custodian.
A self-directed IRA custodian.
That's the term. And one more thing, the Roth IRA can also be set up as an individual retirement annuity.
Which is what exactly?
It's essentially a contract you buy from a life insurance company. It offers guaranteed payments in retirement, but the trade-off is often a lower growth potential than you'd get with market-based investments.
Okay, that sets the stage for what it holds. Let's pivot to the history, because the Roth IRA, as we know it, didn't just, materialize out of thin air in 1997.
Not at all.
The concept actually originated much earlier, 1989, I think, proposed as the IRA Plus.
That's right. That was the genesis of the idea. It was spearheaded by Senators Bob Packwood and William Roth.
And that's where the core logic was first formalized, right? The tax now, save later idea.
Exactly. The early proposal was really quite simple. It would allow individuals to contribute up to $2,000 without getting an upfront tax deduction.
And the reward for giving up that immediate tax break.
The promise of completely tax-free growth and critically tax-free withdrawals in retirement, it was a trade-off designed to appeal to, say, younger savers who might expect to be in a much higher tax bracket later in life.
This brings us to a really politically charged moment in tax history, because the introduction of the Roth was largely a reaction to earlier legislative changes.
It was.
Our sources point back to the sweeping 1986 Tax Reform Act. What happened in '86 that made an after-tax option like the Roth even necessary?
Well, the '86 Act really curtailed the tax benefits of the traditional IRA.
How so?
Before 1986, virtually anyone could contribute to a traditional IRA and deduct that full contribution. Didn't matter what your income was or if you had a 401k at work.
It was universal.
It was. The 1986 Act removed that universal deductibility. All of a sudden, many middle and high-income taxpayers, especially those already covered by a 401k, found they could no longer deduct their traditional IRA contributions.
So that created a huge gap. They had this tax-advantaged account that was suddenly, well, a lot less tax advantage.
Right. And lawmakers then faced a dilemma. Do we restore fully deductible IRAs for everyone, or do we find a more creative way to offer a tax break that won't, bankrupt the government in the short term?
And this is where the political calculus gets really, really interesting.
Oh, absolutely.
Because restoring universal deductibility for traditional IRAs would have meant an immediate and massive cost to the Treasury.
And that would have violated the very strict new pay-as-you-go congressional budget rules they had at the time.
So they chose a different path.
They did. Lawmakers chose a path that allowed them to restrict those fully deductible traditional IRAs to lower-income households while offering the Roth IRA as this attractive after-tax option for everyone else.
And this decision was fundamentally driven by what our sources called the budget window trick. This is a fiscal mechanism every investor needs to understand because it dictates how and why so much tax legislation gets passed.
Yes, explain that. It's genius in a way.
Because the Roth IRA requires you to pay current income tax on your contributions, it generates an immediate and, a very noticeable stream of revenue for the Treasury.
It helps the current budget figures look better.
Exactly. The true economic cost of that tax break, all the foregone revenue from tax-free withdrawals and decades of tax-free growth, that doesn't hit the Treasury until, much, much later.
And why is that timing so critical to how Congress works?
Because congressional budget scoring relies heavily on a 10-year window.
The magic 10 years.
Right. If a tax cut costs money in that next decade, it is incredibly hard to pass. Since the Roth structure generated revenue now and pushed the actual cost of the tax break outside that 10-year window,
it made the Taxpayer Relief Act of 1997 look a lot cheaper on paper in the short term.
It was a classic example of legislative budgeting designed for passage, not necessarily for long-term fiscal prudence.
So in essence, the government was happy to trade potential future revenue for a guaranteed immediate cash flow.
Absolutely. And this structural advantage for the government today led directly to figures like Leonard Berman, the economist cited in our sources, sounding these profound long-term warnings.
Right. He highlighted that this short-term revenue boost comes at an enormous long-term cost.
What were his numbers?
His study calculated that between 2014 and 2046 alone, the Treasury would lose billions, I think it was $14 billion to be precise, due to IRA-related provisions.
And especially the growing use of Roth conversions and non-deductible contributions, which maximize that tax-free growth.
That's the direct trade-off. The government is basically saying, we'll take a small, immediate revenue bump. But in doing so, and this is Berman's direct quote from the analysis, they are giving up much more in the future.
This deferred cost is the core tension of the Roth IRA from a public finance perspective.
And it speaks directly to the savvy of the individual investor, right?
How so?
The government is sacrificing the income tax stream on what could be decades of massive compounded growth. This delayed, enormous cost is a fundamental economic factor that I think is often overlooked by investors who only focus on their immediate tax return.
It really underscores the profound long-term tax advantage the Roth structure offers to those who use it fully. Now that we understand the political foundation, let's move to the most crucial strategic decision for every listener.
Choosing between Roth and traditional.
Exactly. And this isn't just an account choice. It's a high-stakes strategic tax arbitrage opportunity.
That is the essence of it. And it's based entirely on predicting your personal tax rate trajectory.
The difference really boils down entirely to the timing and, I guess, characterization of the tax payment.
That's it.
So with a traditional IRA, the contributions are pre-tax or tax-deductible money today.
Right, which lowers your current taxable income.
And you pay the income tax much later upon withdrawal and retirement. It's a mechanism of tax deferral.
Conversely, with the Roth, you fund it with after-tax money. The income tax has already been paid.
So the qualified withdrawals you take in retirement are tax-free. They are never scrutinized again by the IRS.
Never. But let's stress the massive, often forgotten similarity here.
The treatment of growth.
Yes. Whether we are talking traditional or Roth, all the transactions inside the account, so capital gains, dividends, interest, they do not incur a current tax liability.
That tax-deferred, or in the Roth's case, tax-free growth, is the compounding engine that makes these accounts so powerful compared to just a standard taxable brokerage account.
Precisely. The major distinction, post-growth, emerges when you're in retirement, and it's tied directly to the concept of required minimum distributions.
Yeah. RMDs. And this is a huge game-changing differentiator for the Roth. A traditional IRA functions like a ticking tax time bomb.
The government demands its cut eventually.
Exactly. But the Roth IRA has no RMDs for the original owner. None. That money can stay invested, compounding tax-free indefinitely.
This is a monumental benefit for long-term compounding and especially for generational wealth transfer.
Right, because traditional IRAs force you to start withdrawing and paying tax at, what is it now, age 73?
Right, it's moved up from 70.5 to 72, now 73 depending on your birth year. But yes, you have to take the money out whether you need it or not.
And those withdrawals are taxed as ordinary income.
Ordinary income. The Roth allows the owner to pass that entire accumulated tax-free principal and growth to their heirs without prematurely triggering those tax events.
That RMD exemption allows the Roth to act as this permanent, dynamic tax shelter. It's a true vehicle for legacy planning.
It is. And we should briefly note the change in contribution age limits as well.
Right. Traditional IRAs used to cut you off at 70.5.
They did, but that restriction has been relaxed. However, the Roth was already more flexible. Anyone with earned income can contribute to a Roth at any age, provided they fall below the income phase-out limits we'll get to later.
So the RMD difference remains the most significant distinction in retirement.
By far.
So let's talk about the investor decision framework. How do you, the listener, make this bet on your future tax rate? When does one strategy definitively win?
Well, the simple guideline remains pretty consistent. If you are confident you will be in a lower tax bracket in retirement.
For example, maybe you're working in a high-tax state now, but plan to retire to a low-cost area, smaller required income.
Exactly. Then a traditional IRA is mathematically superior. You claim your tax deduction today at your high marginal rate, and you pay the lower marginal rate later.
You are successfully engineering a shift of income from a high-tax environment to a low-tax environment.
That is classic tax arbitrage.
Oh.
However, if you are currently early in your career and in a low bracket, or, and this is increasingly common, if you anticipate that your future income, combined with the general national fiscal environment, will push your tax rate higher in retirement.
Then the Roth is the undeniable choice.
Undeniable. You lock in today's lower rate to secure decades of tax-free growth that would otherwise be subject to really high future taxation.
And I think this framework needs a critical layer of nuance. The assumption that your income will be lower in retirement might be a bit naive today.
I agree.
I mean, given the complexity of provisional income rules and potential tax increases down the line, are there, defensive reasons for choosing a Roth, even if you theoretically expect a lower income?
Absolutely. The debate isn't just about your personal income. It's about control and anticipating external factors.
Future tax policy.
Exactly. If you believe, maybe due to national debt levels or demographic shifts, that future tax rates at the federal level are likely to be universally higher, regardless of your personal income.
Meaning the current 22% bracket might become 30% in 20 years.
Right. Then the Roth acts as powerful tax insurance. You are prepaying your tax bill now, which eliminates the risk of future legislative increases on that specific bucket of retirement money.
That shifts the thinking from just forecasting your personal income to forecasting national tax policy.
Which makes the Roth a very robust defensive play.
It does. And this leads us to a subtle but really critical mathematical advantage, what our sources call the effective contribution limit advantage.
This is so important. The nominal or stated contribution limit is the same for both account types.
But the reality is they are not equal in buying power or sheltering capability.
Not at all. Because the Roth contribution is funded with money that has already been taxed, it immediately contains more capital that will never face the IRS again.
Okay, let's run the numbers to make this really clear for the listener.
Let's use the current 2024 limit of $7,000 for simplicity. And let's just assume you are consistently in the 25% marginal tax bracket, both today and hypothetically in retirement.
Okay, if I contribute $7,000 to a traditional IRA, I get a $7,000 deduction today. But when I withdraw that same $7,000 in retirement, I'll pay 25% tax on it.
Right, which leaves you with $5,250 after taxes.
52.50. Okay.
Okay.
Now, if I contribute that same $7,000 to a Roth IRA, that money has already been taxed.
You already paid the tax on the gross income that netted you that $7,000. So that entire $7,000 is tax-free forever upon a qualified withdrawal.
So to get the same $7,000 net post-tax withdrawal from a traditional IRA at that same 25% rate, I would need to contribute more than $7,000 upfront.
Exactly. You'd need to contribute $9,333 pre-tax.
9,333.
Right. Minus 25% tax on that, which is $2,333, leaves you with a net of $7,000.
But I can't contribute $9,333 to either IRA.
You can't. The limit is $7,000. Therefore, the Roth allows you to funnel a larger amount of net usable wealth into the tax-sheltered ecosystem than the traditional IRA's nominal limit suggests.
It maximizes the size of your tax-free bucket.
That is the core mathematical truth of the Roth. It provides a higher level of tax-sheltered capital, which makes it extremely attractive for those who prioritize maximum tax isolation.
Beyond the tax timing in retirement, the Roth IRA offers a level of, I'd say, tactical cash flow control that the traditional IRA simply cannot touch.
Not even close.
This is the flexibility factor, and it relates directly to how easily and how early you can access your funds. Let's start with the most unique feature, access to your principal.
This is a major structural advantage, and it gives the Roth a dual purpose beyond just strict retirement savings.
What do you mean?
Your direct contributions, the principal amount you deposit, can be withdrawn tax and penalty-free at any time.
Wait, anytime, regardless of age?
Regardless of your age or how long the account has been open.
That is huge. That transforms the Roth from just a retirement account into a sophisticated, highly liquid emergency savings vehicle.
It does.
If I put in, say, $50,000 over 5 years, that entire $50,000 is available to me without triggering that nasty 10% early withdrawal penalty that would apply to a traditional IRA or a 401k if I needed the cash before age 59.5.
That instant access to your basis is truly unique in the retirement savings world. It provides a level of financial security. You can invest aggressively for the long term, knowing that your original capital remains accessible without punitive taxes if something goes wrong.
Okay, but it's vital to clarify, what about converted money? Money you rolled over from a traditional IRA.
Right, that's a different bucket. Converted contributions do require a specific 5-year seasoning period before they can be withdrawn tax and penalty-free.
So there's a 5-year clock for each conversion.
Correct. But once that specific 5-year clock is run, converted principal also enjoys this penalty-free withdrawal flexibility.
Okay, that's a crucial distinction. We have the 5-year clock for conversions, but immediate access to direct contributions. So when do the earnings, the compounded growth, the engine of the account, when do they become fully tax-free and penalty-free?
Earnings achieve what's called qualified status only after 2 separate requirements are met.
2 hurdles.
2 hurdles. The first is the account level requirement. The 5-year seasoning period since opening your very first Roth IRA must have elapsed.
So that clock starts once when you open your first ever Roth, and once it's satisfied, it applies to all your Roth IRAs forever.
Exactly. The second requirement is a distribution justification.
Okay, and what are the acceptable justifications for pulling those earnings out tax and penalty-free?
Well, the simplest and most common is reaching age 59.5. At that point, provided that 5-year clock is run, qualified withdrawals of earnings can be made in any amount on any schedule for any reason you want.
But there are other qualified justifications for distribution even before that age.
Right, things like death or permanent disability.
And one of the most useful pre-59.5 exceptions, especially for younger savers, is the first-time homebuyer exception.
This is a fantastic provision. It dramatically increases the Roth IRA's value for those saving for a large purchase.
How does it work?
Up to a lifetime maximum of $10,000 in earnings. Not just the principal, but the growth, can be withdrawn as a qualified, tax-free distribution if that money is used to acquire a principal residence.
And who qualifies as a first-time home buyer under this specific rule? I imagine the definition is pretty strict.
It is precise. The funds must be used to acquire a principal residence for the Roth IRA owner, their spouse, or even specific lineal ancestors or descendants.
So you could help your kids or grandkids.
You could, and the crucial, easy-to-miss detail is the 24-month rule. The owner or the qualified relative must not have had an ownership interest in a principal residence during the previous 24 months.
So it really is for a first-time buyer or someone who hasn't owned for 2 years.
Exactly. This means you can consciously leverage the Roth IRA to save not only for retirement, but specifically for a down payment. It makes it one of the most efficient dual-purpose savings mechanisms available.
Okay, let's move to perhaps the greatest, most subtle power of the Roth, particularly in later life.
And that is,
It's operational invisibility when it comes to your adjusted gross income, or AGI. Why does the fact that qualified Roth distributions do not increase your AGI matter so much?
this is where the advanced planning comes into play, and it's all about controlling your tax profile in retirement. AGI is the foundation upon which the IRS calculates your eligibility for various deductions, credits, and, critically.
The taxation of your Social Security benefits and your Medicare premiums.
Exactly.
Traditional IRA withdrawals are taxed as ordinary income, so they flow straight into your AGI.
Right. And if your AGI crosses certain specific provisional income thresholds, up to 85% of your Social Security benefits can suddenly become taxable.
But the Roth is the perfect buffer.
It is.
Yeah.
Because qualified Roth distributions are not considered income for AGI purposes, you can draw a significant income stream from your Roth while keeping your AGI and therefore your provisional income artificially low.
This strategy allows retirees to maximize their retained Social Security benefits by keeping them below those critical taxable thresholds.
That is a staggering realization for anyone planning their cash flow in retirement.
It is. If you have both traditional and Roth funds, you can strategically toggle between them. Take just enough from the traditional IRA to stay under the wire and supplement the rest of your spending needs tax-free from the Roth.
Exactly. But the benefits extend beyond Social Security. That AGI calculation is also used to determine your Medicare Part B and Part D premiums through means testing.
IRMAA, the income-related monthly adjustment amount.
That's it. Since qualified Roth withdrawals are invisible to AGI, they help keep your income below the IRMAA thresholds. That can potentially save you thousands of dollars a year in unnecessary Medicare premium surcharges.
That's truly amazing. So you're telling me the Roth isn't just a retirement benefit, it's a tool for mitigating future healthcare cost inflation.
It's a healthcare cost reduction tool masquerading as a tax break.
Incredible. And that optionality is compounded by the fact that you can contribute to a Roth even if you participate in a 401k at work.
Right, you can aggressively fund both, building that all-important tax diversification.
And finally, let's circle back to estate planning. How does a Roth structure impact large estates that might be subject to estate taxes?
For those large estates, the Roth IRA offers an immediate valuation advantage. Since the tax dollars have already been subtracted when the contributions were made, the valuation of the Roth IRA for estate tax purposes is lower than the equivalent traditional IRA.
A traditional IRA is valued at the pre-tax level.
Right, meaning the estate tax calculation starts with a significantly higher asset base. The Roth structure minimizes the gross estate valuation right from the start.
We have spent a lot of time highlighting the superior flexibility and the long-term advantages of the Roth, but this powerful tool is not without its costs and its pretty significant limits.
No, it certainly has trade-offs.
Let's start with the immediate and most obvious one, the cost of tax now.
The primary financial drawback is immediate, you're right. The contributions are not tax deductible.
Meaning you get zero immediate tax savings.
Zero. You have to use money that has already been taxed at your current marginal rate.
And as the source material consistently notes, for most people during their peak earning years, say between 35 and 55, that current tax rate is typically higher than what their effective tax rate might be in retirement.
That analysis holds for a person who follows a classic income trajectory. If you're in the 32% bracket today, and you confidently expect to drop to the 12% bracket in retirement,
then paying 32% tax now to secure tax-free status later is, well, it's mathematically inefficient.
it is. Compared to deferring the income and paying 12% tax later, the traditional route maximizes your immediate deduction right when it's most valuable.
So the Roth decision is really predicated on the belief that future rates will either be the same or higher.
Or that the AGI control in retirement we just talked about outweighs the current tax inefficiency.
Right. And this leads to the second major financial drawback, which also ties back to AGI, but on the contribution side of
The
things.
fact that Roth contributions do not reduce your AGI.
Exactly. Contrast that with traditional IRA or 401k contributions, which do reduce your AGI.
And that often provides a secondary benefit beyond just the deduction itself.
Why is AGI reduction such a crucial goal for some households?
A lower AGI is the gateway to eligibility for a whole array of other tax credits and deductions that Congress targets toward middle and lower income households.
Like what?
Think about the child tax credit, the earned income tax credit, or the student loan interest deduction. All of these benefits phase out once your AGI crosses specific thresholds.
So by making a deductible traditional IRA contribution, you lower your AGI.
And that can often increase your eligibility or the size of those other credits. Sometimes that results in a larger total tax benefit than the Roth contribution would have provided.
So a taxpayer has to perform a sort of holistic calculation,
Absolutely.
weighing the long-term benefit of tax-free growth against the immediate benefit of a lower AGI that gets them access to more valuable credits.
The decision is rarely made in a vacuum. If a deduction saves you 24% in taxes and qualifies you for the full child tax credit, that combination might easily surpass the theoretical future value of tax-free Roth growth.
Let's move to the hard limits, the annual contribution amounts. These change frequently based on cost of living adjustments, but we need to give the listener the relevant recent data points.
The IRS imposes strict limits. The total IRA contribution allowed per year, and remember, this total has to be split between traditional and Roth if you have both, is the lesser of your taxable compensation and the IRS limit amounts.
And the limits increased pretty significantly recently.
They did. In 2023, the maximum was $6,500 with a $1,000 catch-up contribution for those age 50 and above for a total of $7,500.
And looking ahead to 2024 and 2025, those limits rose again.
For 2024 and 2025, the limit for those under 50 rose to $7,000, and the catch-up for age 50 and older brings the total to $8,000.
And the IRS is vigilant about enforcing these.
Oh, absolutely. Exceeding the allowable investment amount triggers significant penalties.
We should also detail the spousal IRA rule. This is an invaluable benefit for married couples where one partner might not be earning income.
It's critical for family wealth building. It allows a contribution to be made to an IRA, either traditional or Roth, on behalf of a spouse who has little or no earned income.
And the requirements.
The couple has to file a joint tax return, and the working spouse must have sufficient earned income to cover both contributions. It ensures that, say, a stay-at-home parent doesn't forfeit the opportunity to build tax-sheltered retirement wealth.
Okay, now for the biggest barrier for the high-income listener.
The income barrier.
Determined by a modified adjusted gross income, or MGI. This is the velvet rope that keeps high earners out of direct Roth contributions.
Congress deliberately introduced MGI phase-outs to ensure the direct Roth benefit was targeted. You can only contribute the maximum if your MGI is below the bottom of the phase-out range.
And once your MGI hits the top of that range,
If your eligibility drops to zero, you are completely shut out from making a direct contribution.
let's look at the 2021 limits as a concrete example to ground this.
Sure. For single filers in 2021, the phase-out range was quite narrow. It began at $125,000 for a full contribution and was completely eliminated by $140,000.
And for married couples filing jointly.
The range was $198,000 up to $208,000. If your MGI falls within that range, your allowed contribution is proportionally reduced.
So for every dollar you're over the bottom threshold, your allowable contribution shrinks.
Exactly. But the key takeaway here is that MGI limits apply only to contributions.
Right. Once the Roth IRA is established and funded, a high income doesn't matter anymore, does it?
Not at all. The thresholds are only tested annually for eligibility to contribute new money. Once it's established, the account balance, no matter how large it gets, remains fully tax-sheltered and its growth compounds tax-free, even if your income rises far above the phase-out limits later.
Finally, let's briefly cover a few less common but still important drawbacks. First, the lack of collateral value.
This is a regulatory constraint. Roth IRA funds cannot be used as collateral for a loan.
So that limits your financial optionality. You lose the ability to use that wealth for leveraging, unlike assets in a taxable brokerage account.
Correct. And then there's the geographic risk, which is a downside of paying the tax up front.
This is crucial for mobile professionals.
Very. If you pay a 10% state income tax on your Roth contribution today while living in a high-tax state like California or New York,
You give up the opportunity to avoid that state tax entirely if you later retire to a state with zero income tax.
exactly, Florida, Texas, Washington, had you used a traditional IRA, the state tax on the withdrawal would be due when you were a resident of the zero-tax state, meaning you pay nothing on that portion. The Roth forces you to lock in today's state tax liability.
That planning difference alone could sway the decision for someone in their 30s planning to move states in retirement.
Absolutely. And the final sort of dark consideration is mortality risk.
Yeah.
If you choose the Roth and pay tax now, only to die young, you have paid income tax on money that might never have been taxed if you had used a traditional IRA and passed away before triggering RMDs. In that scenario, the upfront tax payment was potentially an unnecessary reduction of your estate.
All right, this section is dedicated to moving beyond basic contributions into the world of sophisticated financial maneuvers.
The fun stuff.
The fun stuff. Let's start with the basics of conversion, turning a traditional IRA into a Roth IRA.
Conversion is a powerful tool. It's designed to move funds from pre-tax status accounts like traditional IRAs, SEP IRAs, or even rollovers from a 401k into the post-tax Roth structure.
The mechanism is pretty simple in function.
It is. You move the money, and you are required to pay income tax on any converted balance that has not already been taxed.
So if I have $100,000 in a pre-tax traditional IRA and I decide to convert it this year, that full $100,000 is included in my taxable income for this year.
That's the core bargain. You accelerate the tax payment, you pay the tax, and then that money grows tax-free forever in the Roth.
We should mention the historical evolution here because it wasn't always this easy.
Not at all. Prior to 2010, conversions were significantly restricted if your modified adjusted gross income exceeded $100,000.
The removal of that MGI limit in 2010 was a huge deal.
It was perhaps the single most important event allowing high net worth individuals to really utilize the Roth vehicle.
And that removal was the genesis of the primary strategy we're focused on here, the backdoor Roth contribution.
This is the method by which high-income individuals who are barred from making a direct Roth contribution manage to fund one anyway.
It's a clean two-step process.
It is. Step 1. The high-income individual contributes non-deductible money to a traditional IRA.
They can't deduct this contribution because their income is too high, so the money is already considered after-tax principal.
Correct. Step 2. They immediately convert that exact amount from the traditional IRA to a Roth IRA.
And because the initial contribution was non-deductible money, when they convert it immediately, they generally owe zero or very little tax on the conversion itself.
And they have successfully deposited capital into the Roth structure while bypassing the official MGI phase-out limits.
Critically, this strategy was given regulatory sanction by the Tax Cuts and Jobs Act of 2017.
Yes, before 2017, there was some legal concern that this two-step move violated the step transaction doctrine.
Which basically prevents combining several individually legal steps to achieve a result that would be illegal in a single step.
Right, and the sources indicate that the TCJA effectively formalized that the backdoor process is permissible.
Congress essentially blessed the loophole. But we must now spend the time necessary to detail the massive critical caveat that trips up countless investors.
And financial advisors and tax preparers.
Yes, the pro rata rule.
This is the danger zone. It's often referred to as the IRA aggregation rule.
And what is it?
The tax-free backdoor strategy only works cleanly if you have no pre-tax money zero in any of your IRA accounts at the time of conversion.
Any of them. So that includes traditional IRAs, SEP IRAs, simple IRAs.
All of them. You cannot simply choose to convert only your new non-deductible contribution.
Yeah.
That's not how it works.
Why not?
The IRS does not treat your IRAs as separate buckets for tax purposes. For a conversion, the IRS applies the pro rata rule across all of your traditional IRAs, aggregating them into one gigantic imaginary account.
Even if they're held at different financial institutions.
Even then, the taxable portion of your conversion is determined by the ratio of pre-tax funds to post-tax funds across that entire aggregated balance.
Okay, hold on. Let's work through a detailed, high-stakes numerical example for the listener. Assume an investor wants to perform a $7,000 backdoor contribution this year.
Okay, let's say this investor currently holds an aggregated balance of $50,000 across all their traditional and SEP IRAs.
$50,000.
Of that $50,000, let's say $40,000 came from pre-tax 401k rollovers or deductible contributions.
Okay, so that's the pre-tax money.
And the other $10,000 is new, non-deductible money, including this year's contribution. So 80% of their total IRA pool is pre-tax money.
The investor then attempts to convert this $7,000 new contribution to the Roth, expecting to pay zero tax.
They will be sorely disappointed. Because 80% of their entire IRA pool is pre-tax, the IRS says 80% of that $7,000 conversion, or $5,600, is considered taxable income for the year.
Wow, so they just triggered a surprise tax bill on $5,600.
And they have immensely complicated their basis tracking by having to file IRS Form 8606. This tax complexity is why this caveat is so critical.
So the only way to execute the backdoor cleanly is to have a completely clean slate, or to get rid of all those existing pre-tax funds.
Right.
How does an investor clean the slate if they already have large pre-tax balances?
The primary method is what's often called a reverse rollover. This involves moving all those existing pre-tax funds from the traditional IRA structure into a current employer-sponsored retirement plan, like a 401k.
Provided the employer's plan allows for inbound rollovers.
Correct. Once those pre-tax funds are out of the IRA environment, the aggregated IRA balance is clean, and the pro rata rule becomes irrelevant for the new backdoor conversion.
That just speaks to the sheer administrative complexity that high net worth investors have to navigate to use this loophole.
It does.
Now, let's pivot to the specialized conversion benefits we touched on, the use of fair market valuation for discounted conversions.
This is truly advanced planning. It's often used with unique or illiquid assets.
So not stocks and bonds.
No. This strategy is employed when an IRA holds alternative assets that lack liquid market pricing. Things like fractional interest in private REITs, private partnerships, or oil and gas ventures.
And the conversion requires using a certified fair market valuation, or FMV, of the assets to determine the taxable income.
Correct. The benefit lies in the subjective nature of valuing illiquid assets. If the taxpayer can support a significantly discounted FMV,
Maybe citing limited transferability or inherent illiquidity.
exactly, then they can convert a large nominal asset value into a Roth IRA while only paying income tax on that heavily discounted FMV.
This is the substantially discounted Roth conversion.
Yes. Our source analysis states that this technique, relying on accepted valuation methodologies, may provide reductions in conversion income tax and subsequent estate tax by up to 75% or more, depending on the assets and the supported discount.
And since that conversion income doesn't add to MAGI for eligibility purposes in the following years,
It provides indirect benefits we discussed earlier, like a sustained reduction in the taxpayer's Medicare Part B premiums because your calculated MGI is lower in the year the IRMAA is tested.
the connection between conversion strategy and healthcare costs is just. It illustrates the deeply interconnected nature of the U.S. tax code. The Roth IRA's tax-free status makes it an exceptionally valuable asset to pass down. It's essentially a tax-free endowment for the next generation.
It is. However, the rules for inherited Roth IRAs are distinct, highly complex, and depend entirely on the beneficiary's relationship to the original owner.
Especially after the passage of the Secure Act.
Especially then, the rules are stratified, requiring meticulous planning. Let's start with the most privileged beneficiary status, to the spouse.
If a spouse inherits a Roth IRA, they essentially step into the original owner's shoes. What are their options?
The spousal beneficiary has maximum flexibility. They can combine the inherited Roth IRA with their own existing Roth IRA.
So it just becomes their own?
Yes, they can continue to make new contributions, and most critically, they are not subject to required minimum distributions during their lifetime.
And the distributions they eventually take remain income tax-free.
Correct. The asset continues its life seamlessly as a regular Roth IRA, sometimes for decades.
Okay. Now, for a non-spousal beneficiary, a child, a sibling, a non-relative, the rules tighten significantly and are now defined by those Secure Act changes.
Right. A non-spouse beneficiary cannot combine the inherited Roth IRA with their own accounts, nor can they make additional contributions. They are subject to mandatory distribution rules.
But the distributions remain income tax-free.
They do, provided the original Roth IRA was established and maintained for at least 5 years before the distribution.
What are the primary mandatory distribution timing rules now for most non-spouses?
The Secure Act effectively imposed the 10-year rule on most non-spousal beneficiaries. They're now categorized as designated beneficiaries.
And that means?
They must receive the entire distribution of the account by December 31st of the 10th year following the original owner's death.
That is a significant change. It limits the ability to stretch that tax-free growth over the beneficiary's entire lifetime.
It does. The ability to stretch the account over the life expectancy of the beneficiary is largely gone for new inheritances.
It is severely restricted. Only a special category called eligible designated beneficiaries can still use the life expectancy payout.
And that includes surviving spouses, minors, but only until they reach majority disabled individuals and the chronically ill. For the typical adult child inheriting a Roth IRA, they must empty the account within 10 years.
Which forces all that tax-free money out, even if they don't need it yet.
Exactly. The tax-free nature is still incredible, but the benefit of multi-generational stretching is now time-limited for most heirs. The goal shifts from perpetual tax avoidance to maximizing tax-free growth within that 10-year window.
Okay, let's shift gears completely and look globally. The Roth is a creature of the U.S. tax code.
It is.
And when a U.S. citizen moves abroad, or a foreign national holds one, we run directly into potential double taxation issues.
Double taxation is a significant risk. It occurs when a foreign government taxes the dividends, interest, or gains generated within the Roth, and the IRS does not recognize that foreign tax as a creditable deduction against U.S. taxes.
Because the gains are already sheltered domestically, the Roth's protected status is often not respected internationally.
Precisely. Our sources highlighted the relationship between the U.S. and Canada, citing the 2008 U.S.-Canada Tax Treaty.
And that treaty provides some relief, right?
It does, but with major pitfalls. The 2008 treaty generally considers Roth IRAs as pensions. This means distributions from a Roth to a resident of Canada will usually be exempt from Canadian tax.
So it mirrors the tax-free status in the U.S.
Generally, yes, and a Canadian resident can elect to defer taxation on the income accrued in the Roth until the distribution is made.
That sounds like a perfect solution for cross-border retirement living. But you mentioned a huge trap.
The bifurcation trap.
Detail why a Canadian resident must be extremely careful about touching that account while living in Canada.
The trap emerges if a Canadian resident makes a new contribution, not a rollover, but new money, to the Roth IRA while residing in Canada.
One new contribution.
One. By making that new contribution, the Roth IRA immediately loses its pension status under the treaty regarding all future accretions.
And the consequence of losing that status is what you call bifurcation. The account splits into two pieces.
That's right. The original balance that existed before the new contribution is a frozen pension and remains subject to the favorable tax-exempt treatment.
What?
But the income accretions generated from the time the new contribution was made onward are now subject to Canadian tax in the year of accrual. It effectively turns the active part of the Roth IRA into a currently taxable savings account in the eyes of Canadian tax authorities.
So it creates a devastating compliance and tax burden.
It's an incredibly subtle, yet financially devastating detail for international investors. You think you're capitalizing on a tax treaty benefit, but one simple mistake ruins the account's tax advantage status for all future growth. Hashtag tag outro.
We have completed our deep dive into the Roth IRA. The analysis confirms that it is an incredibly powerful tool for tax diversification and flexibility.
Absolutely.
It's the ideal vehicle for those currently in lower tax brackets who anticipate high income in retirement, and for those who value the flexibility of accessing their principal tax-free and penalty-free at any time.
Treating it as both a retirement fund and an emergency safety net.
The essential synthesis here is that while the Roth's benefits are immense, it demands precise, informed execution.
You must be hyper-aware of the modified adjusted gross income limits that govern contributions.
And if you are an affluent investor using the backdoor strategy,
Understanding the complexity of the pro rata rule, the fact that the tax character of all your traditional IRAs aggregates during conversion is absolutely non-negotiable.
missing that detail is an expensive mistake.
A very expensive mistake.
We established early in this deep dive that the structure of the Roth IRA is built on a deliberate deferral of revenue for the government.
An immediate cash bump today in exchange for massive compounding tax losses decades from now.
And that brings us to our final provocative thought for you to consider.
We cited economist Leonard Berman's analysis that the government is giving up much more in the future, projecting billions in long-term revenue loss that future Congresses will eventually have to address.
Given the sheer size of the deferred tax liability building up in these tax-free accounts, the question for you, the investor, is this. How long will the tax laws governing core Roth benefits, specifically the RMD exemptions, the tax-free status of inherited accounts, and the continued high contribution flexibility via complex conversions, how long will those remain in place before lawmakers are eventually forced to address those growing revenue holes?
And what political risk should you be factoring into your long-term Roth strategy as you build that tax-free wealth?
That's a question worth investing some serious thought into, especially as your tax-free bucket gets larger. Thank you for joining us for the deep dive.